there, you're with BloombergQuint, and for the next 30 minutes, we're going to talk all things tax in budget 2021. Now, there aren't any big bang tax changes in the budget this year, but don't be disappointed. That's a good thing, because right before the budget, in the legal circles, there were whispers of a COVID tax or an HNI tax, but thankfully, the finance minister has stayed away from these scares. But what Budget 2021 has done, though, it has made several small tax changes that will have a big impact. Now, that's going to be a good or a bad relief. That's going to be a good or a bad development. To answer that, I have with me Sudhir Kapadia and Mukesh Butani. Gentlemen, thank you for joining us here on Bloomberg Quint. Mr. Bhutani, I'd start with you. Let's look quickly at the budget estimates for the next year in terms of the tax targets that the government has set for itself. In gross tax revenue for next year, the finance minister is hoping for an increase of 16.7%. In direct tax specifically, the government is hoping to achieve from the revised estimates of 2021, a 22.4% increase, and on indirect taxes, a 11.4% increase. Given the performance this year, Mr. Bhutani, what do you make of these tax targets?
Well, I think this year, despite being an outlier year, has seen fairly decent tax collection. Of course, we will miss the target, and as the revised budget estimates for 2021 suggest that the last year's budget estimates would not be met. But I think the 16+% overall direct and indirect tax collections is predicated on two things. Number one, that the last 4 months GST revenues have shown a positive trend, and in fact it has crossed 1,20,000 crores. And the second is that if the economic survey projected that the economy is going to grow at 11%, then I think it's fairly safe to assume that the direct tax collections would look decent. Also, even if you look at the quarter to quarter results, particularly of the listed companies that have been announced in the past few weeks. So though there is no material increase in the top line of many of the listed companies, I think a conservative management of expenditure, including cutting costs, which of course has a different impact altogether on the economy, has resulted in fairly decent profitability. So, I think the December quarter results for the current financial year will throw up optimism. And I think that the 16% overall tax collection targets is achievable given the current trend of revival in the economy that we are seeing. But it could be anybody's guess. I think 11% growth rate and a tax collection of 16.7% predicated on that seems to be fairly reasonable to me.
Okay, Mr. Kapadia, are you as optimistic as Mr. Bhutani? And also, what did you make of the overall approach of the finance minister when it comes to taxes this year, whether it is on the numbers front and also in terms of some of the specific changes that we'll talk about in a little detail, just as I get your first quick take.
Right. So I think the first thing to note is that and I think the finance minister herself clarified that the nominal GDP growth assumed by the budget is 14.8%, below 15%, whereas the economic survey has actually posited a not far, but at least 2 basis points higher nominal growth in the next year. So she actually said in the press conference that, we are being more conservative here. Now, obviously, the increase in tax collections are linked to this factor. Because it has been conservatively estimated, one could say that, and I agree with Mukesh, that this would be probably achievable. But if you really, unlayer this a bit, the assumption seems to be far more optimistic on direct taxation than it is on indirect. In fact, if you compute the tax bill for indirect, it's less than 1. and it is, I think, 1.2 odd for direct taxes. So a far greater uptick is expected on the direct tax front. Uh, where is that higher optimism coming in for direct taxes? One is unable to understand or figure out prima facie. But I would only add one more point here, Payaswini, just for just one data point. If you leave aside the COVID year, where of course all the assumptions went haywire, the trend we have been seeing post the introduction of GST is a very healthy increase in PIT, or what is called personal income tax, vis-a-vis corporate tax. Actually, corporate tax collections have been pretty tepid, in single digit. The reason is that personal income tax also includes proprietary businesses, which actually are coming more and more into the tax net with greater formalization and with greater GST discipline and disclosures coming in. So, all in all, I think there is a larger emphasis on personal income taxes in those assumptions, perhaps, than even on corporate taxes.
Okay. Mr. Bhutani, part of this tax revenue exercise is also tax administration, right? How are these changes and approaches or policies of the government are getting implemented on the ground? And there are certain important sort of tax administration and dispute resolution changes that the government has brought in via Finance Bill 2021, whether it is for small taxpayers or whether it is the Settlement Commission. How do you see them unfold in the coming year, and what do you see as the impact of those?
Well, I think you can divide this in two, three ways. Number one, that the successive budgets have taken several steps to be able to carry out an exercise either by way of reduction of disputes, whether it was the 2019 settlement scheme for service tax and excise duty related disputes, or 2020 exercise, which is the Vivad Se Vishwas scheme for income tax purposes. Now, all of this means two things. One, it means that the government collects taxes. Second, it also means that it unclogs the dispute resolution machinery. What we've seen in this year's budget is taking forward that message in two ways. Number one, the erstwhile, and I call it erstwhile because after today's announcement, it is erstwhile. The Advanced Ruling Authority has been dismantled, which was a quasi judicial forum, and instead it is being replaced by uh, an authority comprising of senior principal chief commissioner officers with a change, and the change being that the orders of this authority are appealable directly to the High Court. I think this is fairly reformative in light of the fact that in the past 6 to 7 years, the authority on advanced ruling had really lost its sense of direction, and it was really not serving the purpose for which it was thought of way back in 1993. I think the other welcome feature is this dispute resolution mechanism for small and medium sized taxpayers whose taxable income is less than 50 lakh rupees, and the variation in the income or proposed adjustment is less than 10 lakh rupees. They can settle the overall dispute, including that in the course of the settlement, they could seek immunity from penalty and prosecution proceedings. I think this, in my view, will cover fairly large categories of taxpayers above, with income taxable income below 50 lakh rupees. What that will do is that would help the administration focus on really the large cases which needs to be thoroughly investigated, and the overall quality of the assessments that they pass would be far better. So you will make more optimal utilization of the resources of the tax department. So I think these two changes put together, in my view, are a carry forward of what the finance minister did in the previous two budgets, and are indeed very, very welcome changes.
Mr. Bhutani, quick follow up on your advanced ruling authority sort of point. It was before, let's say, I could go to the formal process of, the tax appellate process. I could get certain sort of certainty on a transaction and the tax implications of it. Uh, is it just that the process is now moved to the commissioners, or
That's right.
what is it that will happen before them?
So I think it is more got to do with the composition of the authority. Right now, the composition was that the authority was chaired by a high court or a supreme or a retired Supreme
Yeah.
Court judge with two
So
members.
I don't
Now
know
the
if that independence gets compromised in some fashion.
well, to some extent, there is a conflict of interest, but I think that this is also accompanied by the fact that these orders are appealable, both by the department and by the tax officials, and that too straight to the High Court. I think the biggest challenge that we had with the current framework of the AAR was that it was not really giving the rulings within the mandated time of 6 months as per the law because of technicalities. Going through two phases of determination. First phase being admission, and second phase being determination. Now, what will happen is that, and the admission was invariably opposed by the tax inspector himself. Now, I think what will happen is that this will become more seamless in the sense that the tax administration will have little reason to be able to oppose or advance determination of tax on a transaction because you have the higher forum of tax administration making that determination. But yes, you're right. To some extent, there is an inherent conflict. But I think if the collegium of this newly set up advanced ruling authority is empowered and is functioning in a independent fashion, then I think it will give you the same outcome that you were getting out of a advanced ruling authority which was chaired by a judicial member.
Okay, all right. We'll see, of course, in the next few months, or let's say the first 6 months, how this unfolds. Mr. Kapadia, I'll come to you with several sort of corporate tax changes or clarifications, if I can call them, that the finance bill has made. One is to do where the bill says that the goodwill of a business or profession will not be considered as a depreciable asset. And they said that where goodwill is purchase price of the goodwill will continue to be considered as the cost of acquisition for the purpose of computation of capital gains. The second important change has to do with the MAT provision being rationalized to adjust certain kinds of income while determining book profits. And the third, I'm told, is to target sort of M&A deals, that were designed to evade tax, and that is that the definition of slump sale has been expanded to include all forms of transfers. I'm not sure if you've assessed in great detail the impact of these provisions, but first, quick thoughts.
Yeah, sure. Just before I come to that, if I can just add on the previous topic, a couple of
Sure.
things to what Mukesh said. So, on the authority for advance ruling, my personal view is that if you look at the history, it worked very well, I think, for the first decade after introduction in the early 90s. What happened after that was, for some reason, one was not able to see the kind of senior judges who were forthcoming. There used to be long periods of absence, or the authority not being able to function, and that really made the whole process quite slow, delayed, and if I may say, frustrating. So in a way, it's good that it is sought to be revamped, because the current format was not working. And I will also add that for some reason, the department has never been enthusiastic about this forum, particularly recently in the last few years. And that is kind of disappointing, because, as I said, the first decade it really worked very well, and all of us have the experience of availing of that ruling on behalf of non-residents in a very, very intense manner. The second point I would just add to that, at least what did not come out specifically, though it is nothing to do with change of the law, is similarly the other forum, which is the Advanced Pricing Authority. It has started off very well. It is still very popular. There are 800 applications pending, but the resolution has become very, very slow. And I think a lot of non-residents, foreign stakeholders have been representing. The finance minister herself in a chamber interaction recently acknowledged that we need to do something about this very soon. And we were hoping to see some announcement, at least it was not overtly there in any of the proposals. So that was kind of disappointing. I think we need to do something very quickly on the APA. And the third one, while I agree with Mukesh that the kind of different forum, dispute resolution forum now being proposed for let's say small taxpayers is a good beginning. But I just wonder that why would one not extend it to all taxpayers? Because really the need of the hour is to reduce litigation and unclog any potential litigation in the courts. Mind you, you are now replacing the settlement commission. The settlement commission was open for all taxpayers. So I also don't know why this is done in such a modest manner. Uh, in fact, as you recollect, the Supreme Court Chief Justice on more than one occasion has exhorted the revenue to consider mediation in tax disputes. And perhaps this was a good opportunity. Maybe this is a pilot towards going for mediation eventually, but it will be good to see accelerated progress. So coming back to your question on the M&A related provisions on slum sale and goodwill, it would be fair to say that there have been some very interesting judgments favoring a particular interpretation on both these topics of goodwill arising in a merger, as well as the argument that in a slum sale, which is just an exchange, there is no capital gains tax. The only point here I would like to make, and again, in keeping with this government's resolve and commitment not to do retrospective amendments, it must be noted that even these amendments are prospective. But the one thing which is disappointing again is disallowing depreciation on acquired goodwill as well. What if I have actually purchased the business and I've paid for that goodwill? Why would you not allow the depreciation on that? Because it's a very important, very key commercial asset. And that logic seems to, at least one will see the fine print and the rules, but on the face of it, disallowing depreciation on acquired goodwill seems unfair. And whilst, as I said, there is a certain view which the revenue has vis-a-vis the favorable decisions. You are doing it prospectively, that's fine. But on this one, perhaps there was a need for a carve out or an exception.
Okay, all right. We will, of course, in the course of next week, like you said, Mr. Kapadia, look at the further fine print of these provisions. Let me go to Mr. Bhutani. Mr. Bhutani, you and I have been speaking on this topic for a while now, and I'm referring to equalization levy, or as it's most commonly called, a digital tax. We also spoke recently on the USTR, or the US Trade Representative Office's 301 investigation report that found that India's equalization levy or digital tax is discriminatory. Now, the finance bill has issued certain clarifications. That was also one of the conclusions that the USTR report had drawn, that the industry has been asking for certain clarifications which have not been forthcoming from the department. So one is that they have said the levy will not be applicable where payment is subject to withholding tax as royalty or fees for technical services. I think that will come as a relief, and you'd agree with that. But they've also sort of clarified the definition of online sale of goods and online provision of services to include a variety of things that our viewers can read on their screens. Are you reading this as an expansion of the levy, Mr. Bhutani, or this is in line with what was understood so far of equalization levy?
No, I don't read this as an expansion. I read this partly as a clarification, and it could help resolve a dispute as well. So I think the first part really is a rationalization measure. It's just a clarification that if any income is liable to be taxed as royalties or technical services, you're not liable for equalization levy, because the ask from the community was, how do I make a determination, because it could be taxed as equalization levy and as well as royalties and fees for technical services. So that's more a rationalization measure. The second one is giving a purposive meaning. Now, in the course of giving a purposive meaning, it cuts both ways. Some taxpayers may have been able to, get into availing of a loophole because of lack of clarity in the law. But to me, it seems that the clarification that has been issued suggests that it would cover brick and mortar forms of businesses that have e-commerce model, pure play e-commerce model, marketplace model, and intermediary as well. So I think to me the fourth category, the role played by an intermediary, let's take a case of a payment gateway. Now the payment gateway person is neither an e-commerce operator nor is running a brick and mortar business with an e-commerce platform. So one could easily, take a shelter of a possible loophole that has been left in the law. Now they would be covered. I view this as more clarificatory in nature. As a matter of fact, these were forming part of a wider gamut of clarifications that we were trying to seek from the Ministry of Finance. And as you correctly pointed out, that the USTR report has criticized India's equalization levy law on many counts, but one of the counts was that it lacks the clarity. So now this clarity makes it very clear. Now I'm not in any way suggesting that this would, cover and encompass all forms of business models. You could still have business models that may not fall in this category, but it could have an economic nexus with India as well. But I think that this is a step forward to clarify what was a nuanced issue in the law.
Okay, we're running very close to the end of the show, Mr. Bhutani. So I'll quickly jump to the key indirect tax changes that Finance Bill has introduced. One of which is the agriculture, infrastructure, and development cess on 25 products, and then a similar cess on the excise on petrol and diesel. But on these 25 products, the basic customs duty has also been reduced, and the finance minister said the intent is not to burden the common man or to increase the prices. The second important change has to do with GST, where the certification requirement for GST audit has been done away with, and finally the concept of matching has been brought in with relation to the input tax credit that taxpayers avail of. On the first one, what is the sort of logic of introducing the cess while reducing the basics custom duty? Is it that the cess just goes to the central government, and then it's at the discretion of the central government to spend it, while the revenue from BCD would have actually been divided between the center and the states?
Correct. So you're correct that had it been a BCD, it would have been subjected to the constitutional requirement of devolution to the state, and surcharges and cesses are not. The only difference between a surcharge and a cess being that cess has to be expended, and time and again the Supreme Court has been emphasizing as a part of the constitutional mandate that you cannot have a cess without a purpose, and also the parliament is responsible and accountable to make sure that the utilization of the cess is for those purposes. So it's a revenue raising measure for which the uh, central government will be the beneficiary, and so would the central government be under an obligation to incur it for these specific purposes. Um, the, uh, the other change that you spoke about on the GST audit, it's a rationalization measure. So there are similar rationalization measures that have been taken up in the Income Tax Act as well. Though in the Income Tax Act, the threshold of compulsory tax audit has been raised from 5 crores to 10 crores, of course, subject to the condition that certain significant transactions are undertaken only through the electronic mode. Similarly, the GST annual audit requirement or certification by a chartered accountant has been done away with, and instead it is moved on a self declaration basis. And the Only rationale and reason I could see in both these things is to reduce the compliance. And if the transactions are going to be monitored, through the GSTNR mechanism, or 95% of the transactions have to be electronic for income tax purposes, really very little purpose is served by having a chartered accountant to do another audit. So this is more a rationalization measure. The last aspect on the input credit is very important. This is very specific to exporters claiming refund of input taxes on the items that have been exported by them. So last 18 months of the GST implementation has suggested that there have been many frauds that have been undertaken. Many of these frauds have resulted in prosecution, but an analysis of that fraud suggests that there was no mechanism to be able to deal with all those forms of incorrect claim of input credit, including the fake invoices. So there are two changes that have occurred. One, there is a penalty of 5 times of the incorrect credit availed, and it is also made so it has made both the person who's claiming the credit and the person on whose behalf the credit is being made also prosecutable offense. So this is again a measure to be able to deal stringently with GST related frauds in relation to claiming false input credit on export transactions.
And if I'm not mistaken, this section has been inserted in the Customs Act, right?
The third one or the second one?
The one which says that a new section 114 AC is being inserted in Customs Act to prescribe a penalty in specific case where any person has obtained any invoice by fraud, collusion, willful misstatement, or suppression of facts to utilize the input tax credit. So while the wrong is being done under GST, the punishment is under Customs Act.
That's correct.
Do you see any sort of operational issues in this?
Well, I think the mechanism will have to be worked out as to how the custom authorities will step in to initiate prosecution in these matters.
Okay, all right. Mr. Kapadia, I'll come to you. You've been quiet for a while now. I'll end the show on your comments on finally the overall sort of scheme of direct tax changes that the finance minister has introduced. Some of them are also I didn't touch upon them earlier, have to do with coming down heavily on non-filers. So the TDS rates have been increased for that. Do you see some of these changes as a concerted effort to increase the tax base? And did you find any other interesting changes that we missed out in the last 40 minutes of our discussion?
Yeah, so Payaswini, just to couple of minutes on the equalization levy point, which got discussed. I would just add my observations. One is that, as we know, there are at least three countries already, if not more, namely France, Italy, and Spain, who have introduced very similar provisions based on nexus,
Yeah.
and which would include, even goods, by the way, not just services. So what
Right.
one is seeing is it is not just what we call bond digital enterprises only, which are being subject to this kind of digital tax levies in country after country, but virtually every business which is reaching out digitally in other countries without a taxable presence, they are certainly getting into the net. Now, this is happening on a unilateral basis because of one simple, you know, uh, condition, which is we still don't have an overall global consensus. And it's going to be very difficult, in my personal view, to have an overall global consensus on something like this. And countries are getting impatient. So I thought I'll just make that point. And the point about US calling out, countries like India, I just think that where it gets well, very interesting now are the Biden proposals, particularly on offshoring penalties, which will give a lever to countries like India when it comes to offshoring of goods to countries like China to say that, look, if you want to do or you want to introduce provisions to protect what you believe is your tax, perceived tax erosion in your country, then you cannot, like, in the same breath, oppose some of these provisions from consuming countries and large populated countries like India and China. That's my view. That when it comes to that, I think the leverage which US will have, if those Biden proposals see the light of the day, perhaps may reduce. But anyway, that's a different topic for another day. Coming to your point on TDS, I think what's happening is you had tax collection at source, where it will, introduced just in the last budget. Now you have a tax deduction at source come in for purchase of goods. Uh, the intention is noble. You want to just ensure that everyone is brought into the tax net. But I just keep wondering that if in on one level, if the revenue rightly so says that we talked about fake invoicing, we talked about digital analytics. That's why we see the highest collection of GST in the last month. If we are successful in doing all of this, why do you really need to keep on increasing the burden and obligations of TDS on taxpayers? Some of them are even now coming on individual taxpayers. One has to see when you are purchaser, or even when you are paying for services, you are getting caught technically under the TDS net. So this begs the question that if you have that much of data available, as we see in most developed or mature jurisdictions, we don't have these kind of all pervasive tax deduction at source obligations. The last point on this is it's not just about the TDS obligations. What is happening is that even if there are inadvertent delays, I'm using the word delays, it's not about non payment, but simply delay in payment. We still have even prosecution provisions being applied. We have independent directors, non-executive directors who have been charged with those offenses for delay in payment of TDS and what have you. So it's not just about interest and penalties, but even prosecution. So I think the point to be made on TDS provisions as a whole is that even if you want to continue with those as an easy way out to track pays, etc., the least which should be done is to really decriminalize uh, all those situations where delays have happened for whatever reason in a large enterprise, and because of which you cannot have non-executive independent directors as also principal officers of the company being charged with criminal offenses just because some delays have happened in the myriad of TDS obligations which today a taxpayer is faced with. That would be my comment on TDS. And one last quick point, perhaps when you asked about any other interesting provision, we'll have to wait and see what comes out of it. But if you have noticed, there is a mention of capital gains tax instead of tax as interest income on zero coupon bonds. Many of participants may perhaps remember that when we had development financial institutions, which is now being introduced again, and I see a connection therefore in this provision, when we had these DFIs earlier, a very popular instrument was zero coupon bonds. And for a long time, it was taxable. The income which you earned in the year of redemption or maturity, the entire proceeds minus the principal was taxable as interest. So imagine in today's context, somebody could be taxed at 43%, 37%, 36%, whatever, if you are a HNI in the year of redemption. What I found interesting in today's announcement is a specific mention for specified zero coupon bonds or zero coupon bonds issued by specified infrastructure institutions or infrastructure debt funds to be subject to capital gains tax treatment and not interest. This would be very interesting. It would make the after tax yield very attractive and may perhaps result in large scale mobilization from domestic investors for these infrastructure projects which the finance minister talked about. It's a product which I think we should watch out for from a after tax yield perspective, as I mentioned.
Thank you, Mr. Kapadia, for pointing that out to us. And of course, Mr. Bhutani, for your thoughts on the various indirect tax provisions and the changes to the tax administration process. This, of course, by no means is an exhaustive analysis of the direct and indirect tax provisions. For that, do stay tuned to BloombergQuint over the next few days. We promise to get into the nitty-gritties of all these provisions to analyze the impact for taxpayers. Thank you for joining us, and have a great week ahead.
Thank you.